Hello, and welcome back to my Fireside Chat. Today, my guest is a senior executive who has spent over a decade in the field of life sciences, where she did early stage investments in biotech startups. First, as a principal with Sofinnova, which is one of the leading European venture capital investments in the life sciences space. Then, more recently, as a partner with Roivant, a healthcare company focused on applying technology to drug development. So Sara Nunez-Garcia is also right now in the process of raising a new vehicle, her own fund, and we will let her tell us a little bit more about it later on. Sara, thank you for making time, and thank you for joining me for our Fireside Chat.
Thank you, Claudia. Thanks for having me.
So the title of the Fireside Chat we decided on was Decoding Biotech. And the first question I would like to ask Sara, give us a little bit of history on investing in biotech, and obviously maybe a little bit of color on how life has been in the biotech space in 2020.
Sure. Happy to elaborate, Claudia. So I think people are familiar with the pharma industry. Pharma industry is an old industry. Some of the pharmas that people might be familiar with are over 100 years old, and they started as chemistry companies, evolved into biology companies. Now the biotech industry is a much younger industry. It goes back 45 years ago. So it started with companies like Cites, Genentech in the 70s, and the idea there was to have these nimble companies take risks, when it comes to innovation, scientific and medical innovation, that the pharma industry would not take, to go for those high sky ideas that were worth backing, but the pharma industry would not do that. So that's where it all started. I think the early venture capital firms backed successfully many of these companies. So fast forward to today, we have statistics that the venture capital industry back in biotech has actually panned out. If you look at drugs approved today by the FDA, for example, over 2/3 of drugs, medicines approved today were developed in VC-backed biotech companies. So obviously, when they were approved, they were already acquired by pharma, but the origin of innovation of the drugs approved today, that is in biotech. So, which is basically the engine of innovation today. So that is the idea of biotech industry, which we hope is going to continue to flourish. So your second question, biotech, is an industry that has matured quite a lot in the last 10, 15 years. It has become a lot more stable, more resilient. This year has been pretty spectacular, for us, when it comes to the private financings, the public financings, the follow-ons, the pipes, the debt financing. I think it has exceeded any expectations, despite the hard year for many of the industries. So for us, we see it as an asset class that is no longer the risky asset class that some investors, some LPs used to see. I think if you compare to other asset classes, it has become a pretty resilient asset class that people are attracted to.
So let's maybe start with a comparison, because biotech obviously means early stage investment, or investments at a very early stage of the development of the company. Let's try a comparison to traditional venture capital, and just help us understand a little bit, or put it into context. How biotech funds are potentially different from a typical structure of a VC, a typical LP GP structure. So with regards to mandate, the length of fund, fee structure, maybe, are there any differences?
Yeah, thanks for the question. So think biotech VC today is borrowing from, some of the terms that, came from, 40 years ago. So it's actually borrowing from terms that other industries use today. So when it comes to the GP commitment, the management fee, key clauses, expenses. So those have been borrowed from other industries today, for the most part. Now, the question is, given the vastly different nature of biotech when it comes to other industries, should they be the same? And I think, one could argue that, GP commitment should be the same, expenses, key man, but there's specifically one term that I think might be misaligned when it comes to biotech venture, which is the term of the fund. Most funds are structured as a 10 plus 2 fund, so close-ended funds, 10 years, so 5-year investment period, and the next 5 years, divestment period. You think about biotech, it takes such a long time to put things together, to run experiments, to go into the clinic, the company pivots, to something else because it failed. It is very difficult for a biotech company in, say, 5, 6, 7 years to create, the value creation that we expect, for venture-backed companies. So if you're thinking about 15, 20x, it is very difficult in biotech venture because the capital that you require per company is massive. The time to value creation is very long. So that is the one term that is perhaps not perfectly aligned when it comes to biotech. It is very, very, and we do have examples, great examples in Europe. We don't have to go very far. BioNTech, Galapagos, Actelion, Genmab, those are examples of great companies that didn't take 6 years. It is possible to create good value in biotech in 6, 7 years, but it's very difficult to do that 20x in 20 years because venture doesn't scale. So again, we have started to see in some funds that they're asking for a 15-year fund, 15 plus 2, as opposed to the 10 plus 2. That's something that we've seen. Another aspect which we would appreciate, as fund managers, is the possibility to recycle some of the capital. For example, if you do 100 million fund and you have a 2% management fee, that means 20% of your fund, so 80 million, is going to be deployed in companies, whereas the best deployment of the capital is in the portfolio companies. So what I have started to see is that fund managers are asking LPs the possibility to recycle the first proceeds to be able to invest 100% of the capital, deploy that, to be able to maximize the upside.
Yeah, and I guess hopefully the more attention the industry receives from maybe even new LPs, new to that space at least, the more you will be able to bring LPs over the line, and they will appreciate where the value lies. So staying with the funds for a little bit, what's the typical profile of partners in a biotech fund? So for example, on your side, I mean, you are an alumna from INSEAD, you have an MBA, but you also have a PhD in chemistry. Is this kind of the typical profile that you would find on the investment professional side in biotech funds?
Yeah, so US and Europe, it differs. Cannot comment so much for Asia, but can comment for US and Europe. I think in Europe, what you see in partnerships is heavy on the venture side. Most of the partners, or many of the partners in venture funds, biotech funds in Europe, have been in venture for 15, 20 years. You're starting to see what I think is a positive trend in the US, that firms, partnership are starting to hire partners with heavy, deep operational background and industry background, which complements their partnership. And I think that is basically trickling to Europe. And I think that is exactly the DNA that we've constructed at our fund, 4051 Ventures. People that come in with deep expertise in the industry, whether it's M&A transactions, whether it's, it's development, preclinical development, clinical development.
Right. And ultimately, that will also help the entrepreneurs. So,
Yes,
but we'll come back to that later on. But staying with the with the investee companies, talk to us a little bit about sourcing of opportunities. How do you in biotech find those opportunities? Because very often you may be investing at a stage where it's still in the lab, where it's very much, it may just be an idea. How do you find those opportunities? It's always a good question in venture capital anyway, because you're not dealing with existing companies as you would in buyouts or in growth equity investing. But in your case, where do the opportunities come from?
So I think I'll make two distinctions, because biotech VC is still broad. Some VCs are so-called Series B VCs, or they wait for established companies that have raised Series A, and then they just put 10 million or a higher check. Now, I will refer now to the sort of the venture builders, seed Series A VCs, where the deal flow is not there. You'd have to create that deal flow, which is, what we do in our fund. So you will see us, spending very little time, online, researching or finding. That is not something that we spend too much time on. I think what drives our deal flow, which is the quality of our deal flow, it's directly proportional to the quality of our network. It's as simple as that. We take care of our network takes care of our deal flow. It's as simple as that. Network could be anything. People we went to business school with. I have received a number of opportunities from, INSEAD colleagues, people we worked with. It could be anything. I think the quality, the respect, the credibility, they are the best source of our deal flow. It's not just the number of the companies, you could get many cold calls and so on. But I think for us, what is important is to keep an extremely healthy and productive network. So we spend pretty much all of our time with the network. And, we already see it, 80% of the deal flow that we receive comes from the network. And it's opportunities, deals, assets that we are pretty sure that they are not in the public domain, and then we're getting one of the first calls to have a look at those assets. So this is how it goes. And it could be talking about, having coffee with somebody and they said, well, I have an idea, or I know somebody, or there's an asset there. It always starts like that. And then they put you in touch and you go and find the asset. And this is the source of the best deal flow for us.
Very interesting. So let's have a closer look at the investors in biotech. You touched on it a little bit early on, but what type of investors do you see? And specifically, do you see a strong or stronger activity from CVCs as well? So basically corporate venture capital vehicles that act as LPs in standalone funds as yours.
There has been an evolution of the DNA of LPs in biotech funds. If you go back, 20, 25 years ago, it was the typical institutional investor that invested in those funds. That has dramatically changed. Now you see funds in biotech that are 100% family office, high net worth individual endowments. So now you could see obviously the institutionals and some asset managers, pension funds, insurance companies, but very importantly in the last 10, 15 years has been the corporates. Most pharmas and mid-sized pharmas, CROs, CDMOs, service providers have positions in funds. Obviously, they act as a strategic investor. They want to see the deal flow. They want to work with your portfolio companies. So there's some strings attached sometimes in there. So they are a pretty important source of, say, capital for funds today. And you see, obviously, the governments are still there supporting very much funds, family offices, endowments, sovereign funds. So not just the type of LP has broadened, but also the geography. Now we see Asian investors, South Korean investors, Japanese, Brazilian, Middle East. So it's not uncommon to see in a biotech fund raising a fourth, fifth fund to see a pretty diverse, kind of like types of LPs, people that have invested in biotech and people that have not invested in biotech. There are other corporates that have never deployed capital in a fund. They've never done a fund position, and now they're going into biotech.
And so you're in the process right now of setting up a new fund, but I know you've in the past mentioned that there are so very few new biotech VC brands being created today compared to other industry verticals where we've seen, especially in the last 5 years, lots of new investors popping up. Why is that?
So there are a few reasons why it is so. I mean, the barriers to entry in biotech VC, I believe, are much higher than in other industries, and there are various reasons for that, and I will try to explain some of them. I think one of them is the team. To be able to source high quality deal flow, to have the judgment, to do those judgment calls and decision making when it comes to every little problem that happens to every portfolio company every day. You need a team that brings 20 plus years of experience in the industry. Sure. And so it is difficult. I haven't seen it out of school to 4 people get together and raise a biotech fund. That typically, I haven't seen that very often. I mean, you do need the credibility, the track record, the network, and the judgment. Haven't seen many failures. So you need a team that's in the 40s and 50s usually get together. That is really the right time to take that type of risk. And it's much more difficult to find that later stage than out of school in the beginning. So I think that is one. I think the second one is the size of the fund. We've talked to many fund managers that have a below 100 million fund, and those typically have not worked out very well. You need, a lot of capital to support these companies. They go, through many ups and downs and many pivots. So the size of the fund, for a biotech fund, it has to be 100, 150 plus to make sure that the management company is viable, but also you can deploy enough capital in each portfolio company to have enough equity ownership at exit, and to be able to keep following on the company as much as possible. So we're talking about 150 million fund. So you're looking at a couple of years on the road at risk to raise that fund, with later the GP commitment that you usually have to put in the fund. So there's a number of, say, high barriers. I think in other industries you can do a micro fund, 50 million, 20 million, and you can actually do a lot. But some of these safety experiments, clinical trials, they're north of 50, 60 million. So the capital requirements are orders of magnitude larger in biotech than in other industries. So those are two. I mean, the last one, what I would say, it's sort of a bias from LPs that have shied away in the past from this asset class, biotech, thinking that it was too risky. They don't understand it. I think COVID has shown that there's no asset class that has been spared. I think many asset classes that everybody thought were stable and risk-free, they turn out not to be. And there are some of them. And, biotech, on the other hand, has been booming this year. So again, I think it has been the perception of some of the LPs in the past to shy away from something that they saw as risky.
So let's have a look at the startups, the company that you basically invest in. So what's a typical journey from A to Z for one of those startups? And then tell us a little bit about the kind of founder teams. Also, what your preference is for founder teams?
Yeah. So again, many ways in which things can get started. When it comes to venture formation, venture building, there's nothing there. So you have to get a call from somebody, an email from somebody. There's somebody with an idea, or there's an asset in some pharma. You should go and talk to X, Y, Z. And this is where it starts. You get on the phone, you get on a plane, you get on a train, and go and talk to the person. And you spend a fair amount of time understanding the asset, but also reading between the lines, the probability that you can work with that person. Sometimes it's just an asset, so it's simpler. You get an asset and then you bring in your own team, people that you have worked with, so it may be easier because you have worked with them in the past. Sometimes it's a person that comes with an idea and they want to run it. They want to be part of it. And then we spend quite a bit of time really aligning on what is your vision of that company? What is our vision? Because venture capital is not for everybody. It's not for every company. So I think people need to understand the limitations that we have as fund managers within the portfolio. And it's basically a few months, and then we quickly go into what we call the seed. I think it's very difficult to de-risk the company, the team completely just discussing. I think the best way to test the team is to actually do an investment. So we typically do a 3 to 5 million investment. You get to see people executing, not telling you this is what I'm going to do. You see them doing, what they said they wanted to do.
Sure.
And then usually a couple of years, you de-risk the company. And then after that is the Series A. Typically in biotech, we're thinking about 40, 50, 60 million. In Europe, in the US, we've seen Series A of 100, 200, 300 million. Then Series B. And the equity story of many of these companies, it's an IPO. I think many of these companies, just because the large amount of capital that is needed to go from A to Z in biotech, you can tap into that capital in the public market. So going public on the NASDAQ, typically it's the NASDAQ, which is the more liquid one. Those companies will go public at some point and raise capital. So it's A to Z. Venture capitalists, it depends. When the company goes public, they tend to step down from the board. But it depends. Some of them divest their position early. Some of them wait for clinical data. It really depends on the risk appetite. At least we try to stay as long as possible and really benefit from the upside.
Sure. And when you are you mentioned before that at times you find assets and then you can kind of marry them and match them with your team, which is kind of more the venture builder model around it. But what are the unique kind of main thresholds that you are also looking for? So an attractive asset, what would get you over the line, maybe in a personal capacity? What has made good investments in the past for you?
So for me, again, it goes back to the team and the judgment. Because I think sometimes you look at data, two different people look at data and they see different things and their bias kicks in. I think we fundamentally want to back great people that see potential in great assets. So for us, other than the team, which is the most important thing, it's the unmet medical need. Again, I think venture, it is my opinion, but venture should be backing things that have the possibility to cure diseases or to make a big impact in patients. So I think the unmet need and the effect size, how much benefit could this drug provide? Are we talking about 10%? Probably not for us. Are we talking about 80%, something we're putting 15 million or combined 200 million behind that? So again, it's team that can have a good judgment call, asset by asset. But again, after the team, what drives us is the unmet need. Whether it's a small indication or a big indication, something that has the potential to dramatically improve not just patients' lives, the families, the payers, and reduce the cost of healthcare. The complex thing in biotech is that you may have great data in the preclinical stage. Once you push it to the clinical stage, maybe it's a gray area, and maybe is not good enough. I think that the difference between biotech and other industries, which people may not appreciate, is that you need to be non-inferior to something that already exists. You cannot just approve any company. It has to be non-inferior to something that already exists, to the standard of care. So by definition, the bar is quite high. And we've been, as an industry, pretty good in the last 30, 40 years in putting better and better compounds out there. So we're constantly raising the bar of how good the new medicines have to be. They have to be as good as something that's already in the market.
Very good. Now let's talk about cap tables. So you mentioned before capital requirements are high in those startups. So the typical structure in a biotech startup, I would assume, is involves quite a few investors on the cap table. So how strong are basically the terms in the biotech VC industry? And when do you have many investors that basically come in? Do the last ones coming in ultimately call the shots then with regards to exit and with regards to terms in general?
Yeah, it's a complicated question. I'll try to break it down. So again, I think there's also quite a big difference between US and Europe. I think one thing that we like about Europe is how capital efficient, and also the valuations are quite lower than in the US. So we're thinking about a seed investment, for example. So going in first, you're thinking about 50, 60% ownership post-seed, which obviously you get diluted over time. Now, the complexity of biotech, and again, it goes back to the previous questions, you need to raise so much capital. And the size of the life sciences funds today are small, are 200, 300, 400 million funds. And you can only invest, say, up to 10% per company. So you need to constantly bring new investors and new investors and new investors. So you start with the angels and the local investors and the VCs and the crossovers and the public investors. So in a way, because at some point you cannot follow in the company because you've maxed out how much capital you can deploy per company, you sort of pass the company to the next investor, to the crossover, to the public investors. And every time you pass over the company, so to say, the board changes, there's new terms, and so on. So I think it's one thing that people, I think, don't appreciate is that every time you raise capital for a company, there's a sort of a changing on the board and the terms, and there's some amount of fragility in the company. The strategy, they could actually change your strategy, and I've seen it in some of my companies. At Sofinnova, I think maybe Series B investors, Series C investors come in with 70 million, 80 million, and then dramatically change the last 5 years of the construction of the company. So every time there's a new round of investors coming in, they don't only bring capital, they bring on their new ideas, maybe new management. So there's a fragility to lose the continuity of the company, and management know that. And that is a consequence of how much capital you need.
Let me maybe circle back to you alluded a couple of times on the differences between the US and Europe, and especially on the valuation side. Does it mean if valuations are more attractive in Europe, that Europe has become a kind of a hunting ground for US biotech funds? I mean, have you seen an increase of American-led dollars coming into Europe?
Yes, and that's a good question. Yes, I mean, US investors are very interested in deploying capital in Europe. If you talk to Sofinnova, 15, 20 years ago, US investors didn't come to Europe. There was, the industry was, was growing in the US, was no reason, but the science is as good as, any science that you see in the US. We have now talented people in Europe that, returnees or people from pharma that, now know how to develop compounds and run companies. So we have the ingredients in Europe to make, great stories. Now, the tricky thing about Europe, which I don't think is going to be solved anytime soon, it's how highly fragmented it is when it comes to obviously different countries, different languages, different cultures. How you talk to a university in France, or a professor in France, a professor in Heidelberg, in Germany, is totally different. You need to speak their own language. You need to speak their own culture. You need to have a lot of patience. I mean, we are not in Europe. We are not yet, when it comes to very early stage investing and entrepreneurs, at the same level as the US.
For the founders, for the entrepreneurs, this is it's a good thing to if the American investors are coming to Europe, and if you have choices, obviously, I mean, as you said, I mean, you have to be able to work with the investors as well. In the past, also, we've seen founders having to go to the US to raise follow-on funding, and I think we are seeing that pendulum slowly shift as well. It's not as important anymore for founders to have to step outside Europe. They can find investors on their home turf, which actually is important. So even more important for your fund as well that you are raising. One final question. Being a woman in early stage investing is a pretty unique position. So do you see specifically in your space in biotech more female investors, or are you more often than not the only woman in the room?
So often, I mean, it has changed.
Okay.
I mean, I can give you two examples, which is the two firms, investment firms I was engaged with in the past, which is, Sofinnova and Roivant. They both have this excellent track record in attracting talent, whatever it looks like, whether it's women and minority. And I think that gives you quite a big confidence to continue. It's true that we are a minority, and it's true that perhaps the opportunities that we have are less than if it was a white male. I don't spend too much time thinking about the percentage of opportunities that I get versus somebody else. I am aware that probably I don't get 100% of what somebody else would, but the opportunities are there. Any woman, any minority, the opportunities are there. You just have to be ready and work extremely hard. Has it happened recently that somebody comments on being a woman? Has happened a couple of times, but rarely, versus, for example, 8 years ago when I was at Sofinnova and I was pregnant, on a board meeting, people were just speechless. I think that happens less today. I think, somebody mentioned the other day, I congratulate you because you're a woman raising a fund. And I thought it was very funny. But I don't think so. I think, obviously where I am today is a consequence of the work that many of the women have done, including, partners at Sofinnova and women executives at Roivant. So I owe how easier it is for me to the work that has been done before. But sure. I don't think there are many more or many less opportunities for women now. I don't think when I'm pitching to an LP, he's spending too much time thinking about how odd it is that a woman is raising a fund. I think what they're really interested in the quality of the companies and the return they're going to make, in the fund.
How about on the entrepreneur side? How many women do you see? Because that's a good question as well. I mean, science is usually is considered a male domain, but then again, I mean, we've seen in Europe, Biotech is a German couple that basically has worked together and is not on their first rodeo either. So, do you see more women in the sciences side, especially in the life sciences side?
We see women. C-level, maybe less so in the driving CEO seat. Okay. I'm part of an association or Springboard Enterprises that really helps, women, find capital, mentor them. And there is a bias for sure. And, we cannot deny there's a bias, but there's not a bias against women. It's a bias against what people want to back people that look like them. And is the same bias that I've experienced, when you go on interview for a firm and then they're all different to you, then likely they're not going to hire you. So again, I don't think, at least we don't look at this as a, women-led or no. I mean, we just want you to execute. So again, I try not to say, play the victim. We will be, much farther, 10, 20 years from now, I think women have equal possibility today to raise capital, to run great companies, to create great value. I don't see a big difference today.
So thank you very much. Thank you, Sara, for joining us. Best of luck with the fundraising. So we will be keeping a close eye on that. And good luck in building the pipeline of finding exciting entrepreneurs. So
thank you.
Thanks very much.
Thank you, Claudia. Bye.